In this video, I'm going to teach you how to identify imbalances and of course how to trade the forex market using them. So stick around to fully understand what I'm about to teach you. This is UCFX. Welcome back to my channel. This channel is all about helping forex traders get acquainted with the necessary information and knowledge on how to become profitable in the forex market. So if this is you interested in content like this, do well to subscribe to this channel and turn on the bell notification icon to actually get connected and know whenever I upload new videos. And don't forget to drop in the comment section any topics that you like us to make videos on. I'll do my best to actually tend to those topics and give it my best shot. So without wasting much of the time, let's get started. Alright, let's first of all try to understand what imbalances are. It is simply institutional reference points where the institutions return to for fair valuation. That is, institutions would seek for fair valuation at these market imbalances. Okay, enough of the big drama. Let's look at the chart and try to understand what these imbalances are. So here we are. This is AUD, USD, and this is the daily chart. So I'll be showing you how you can identify these imbalances and as well how you can trade them. So when we talk about imbalances, you need to be looking at sharp price movement or impulsive movement. Just like we have here, we have this big red candle, and as you can see, there was a sharp movement of price downwards. Mind you, this is a daily chart, so there are lots of other bearish candles if you go down to the H4 time frame. So how can you identify these imbalances? After seeing these impulsive moves, you want to be marking out the opening or close of the previous candle. As you have here, you have our green candle, so which means this is our opening price. So we mark out the opening price, and then we mark out the closing price of the next candle, because this is a green candle. We're going to be marking out the close of the red candle. If it's a red candle, you're going to be marking out the opening. I'm sure you know about the highs and lows of candlesticks, the green candlesticks and the red candlesticks. So that's actually an elementary part of learning the candlesticks. So we mark out the highs, the close of this next candle, which is a bullish candle. So inside this area is what we have as our imbalance. So the institution will seek fair valuation, trying to mitigate or tap into these imbalances before price moves to their intended direction. Just like we have, if you look a little bit closer, you will see that price tapped a little bit into this imbalance, but it was not perfectly filled up. So probably in the future, price might come back to fill this imbalance. And mind you, not all imbalances actually work. So that's the more reason that you actually that's the more reason why you should pay attention to this teaching, to this video I'm making now. So let us try to identify other imbalances. As you can see here as well, we have this impulsive move, and then we have the previous candle as a bullish candle. So we're going to be marking out the opening price here, and then we mark out, and the next candle is a bearish candle. So in this situation, we're going to be marking out the opening price. So remember, the bearish candle opens here and then it closes here, while bullish candle opposite is the case. So we're going to be marking out the opening of this candle. So inside this area is what we call imbalance, and as you can see, price came back and tapped into this imbalance, and there were tones of liquidity. So this liquidity was actually taken out and price tapped into this imbalance and then continue going downwards. So this is practically how you can identify imbalances. So another thing you need to note is you need to actually identify these imbalances on higher time frames, the monthly, weekly, and the daily time frames, and then use the lower time frame, the H4, H1, to actually see more of the price action and know how you can trade it using even the lower time frames, the 15 minutes and the 30 minutes time frame, to actually know how you can trade it. But basically use the higher time frames to identify them because they are more effective. So let's use this last imbalance to illustrate how you can trade imbalances. So we are now entering the parts of how you can trade these imbalances. So after identifying your imbalance, just like we have here, this daily chart, you have to go down to the lower time frame, the H4. Let's go down to the H4 time frame to see how price to see a clearer price action. So this area is our imbalance, and as you can see, there were tons of liquidity inside this area. Many people were trying to sell from this point as price kept touching this area. So many people were trying to sell from this point and this point, but they were all taken out with this sharp movement. So they're all taken out with this sharp movement. So after you identify your imbalance, what you need to see next before you start selling or buying from the imbalance, just like we have here, we want to sell from the imbalance. So we need to spot out liquidity. There must be a graph of liquidity, and as you can see here, there was a graph of liquidity, and you need to see a break of structure. If you look to we go to the monthly time frame or the weekly time frame, you will see that price broke structure. Look at where we are. So price broke. There were many breaks of structure. Price broke this area, and if you still look to the left, you see that price took out these lows and the rest of them. So you need to spot out break of structure, liquidity, and then you need to allow price to come back into your imbalance. And as price comes back into your imbalance, what you need to be looking at for next is you need to wait for a tap of price into that imbalance, or a tap of price into a discount level. So if we take our Fibonacci from these highs to these lows, you will see that price tapped into our discount level, which is the 0.681 and 0.786 of the Fibonacci 2. So price slightly tapped into this discount level. So the number one, break of structure, formation of liquidity as price is going back to your imbalance. And the number three is discount levels. So if you don't actually understand about this concept I'm actually showing you, you need to actually learn more of the smart money concepts videos that I made here in my channel to actually understand more about this concept here. So after paying attention and spotting out all these confluences and seeing that price as is at a discount level, you need to go down to the H1 time frame. So if you go down to the H1 time frame, after seeing that price tap into your discount level, so this is a tap into our discount level after clearing all these liquidities. So we need to wait for a break of structure, and if you look closely, you will see that we had a break of structure after price tapped into this area. Price took out these lows. Price took out these lows. Price took out these lows, and then so you practically need to repeat the same thing that you did on the higher time frame. You need to spot out a break of structure, liquidity being taken out. As you can see, we have liquidity here in form of equal highs. So these are all liquidities being taken out. So price took out liquidity and tapped into a lower time frame order block before moving downwards. So let's go down to the 15 minutes time frame to actually see this clearly. So this is the 15 minutes time frame, and this is our liquidity. This is our liquidity being taken out, and then this is our breakup structure, and this is our breakup structure. And then what next? Price tapped into our 15 minutes time frame order block. So this is our 15 minutes time frame order block. So let's try to actually see. So here is our 15 minutes time frame order block. Let me try to sort it out. So this is our 15 minutes time frame order block, and as you can see, price tapped into this order block and went lower. So this is practically how you can trade imbalances. First of all, you need to wait for price to break structure. As price is going back to your imbalance, you need to spot out liquidity, and you need to make sure the price is at a discount level after taking out your liquidity. After taking out the liquidity, then after that, you now need to go down to the lower time frame to spot out a lower time frame order block, a break of structure, liquidity formation as price is coming back to this order block, and then this is where you start taking your entries from. So if you had taken your entry from this point, your stop loss will be slightly above this 15 minutes time frame order block, and you'll be having as little as 17 pips of stop loss, and then you target the next lows using the higher time frame. Let's say the H4 time frames. So you need to target the next lows on the H4 time frame. So you'll be targeting these lows, and then you'll be having about almost a 1 to 8 risk to reward ratio, and this is it. So this is basically how you can identify and trade imbalances. So if you want to understand more of this, so check out more of my videos on how to trade order blocks and imbalances as well, because I've made videos in the past talking about imbalances. So do well to check it out and understand more of everything that I'm actually saying here if you're actually getting confused. So see you on my next video.